welcome to the live stream today. And today it's going to be a fun topic. And the topic today is going to be, typically we do a case study on Wednesdays, but I thought I would do something that would be, I think, a really fun topic to cover today. And that's going to be this. So let me show you guys my screen, and hopefully this will make some sense for you guys. So share window. And share. Here we go. So today's topic is going to be the other day I had a video that about multifamilies, and I was talking about how Chicago is the number one. Yes, you heard me correctly. The number one market in terms of owning rental properties, in terms of building a portfolio. And it has been for the last 10, 12 years. And somebody, I think it's Nurshid Beg, had a very, very, very good question. So we thought we would address that today. Hopefully you can see that question. And that was, Andrew, how is this possible, right? What are you talking about? The taxes are high. The laws in Chicago are very favorable, meaning they're pro-tenant laws. The crime rate is high in Chicago. This was his claim. Major companies are all leaving Chicago. And people are leaving, and how is it that the rental market in Chicago is number one, right? I've said this since 2011 is when I started, I made this claim, and I'll be 100% honest, I made this claim, right? And I made this claim, and I'll explain today how and why I say exactly what I say. And I challenge everybody, and this is not meant to be an ego-driven thing. This is meant to be, because this is very educational for all of us. This will teach all of us what to look for in markets, right? So, Mr. Nursaid, I think Nursaid is the right way to say it. Beg, thank you very much. We appreciate you bringing this up, because this, I think, is a great, great, great topic to talk about. So having said that, let's get started. So why do I say that Chicago is the number one market? So let me just kind of put this in perspective. And let me just say, it's not just Chicago, right? Chicago is one of the ones. Obviously, we're headquartered out of Chicago, and our second headquarters today is Florida, right? And clearly, if we're in the market, we see a lot of margins in Chicago market, but there are markets like Chicago. So what do I mean by that? And this is important to understand the geography of the United States and how things work. So you have the markets, which I'm going to call, and I'm going to start in the Midwest, and we'll expand out, and we'll explain the thinking behind this, and we'll come back to why Chicago. Right? So if you look at the big markets in the country, you're going to have New York, you have LA market, you have Chicago being the third largest market, right? Then you have the Dallas, you have the Atlanta market, you have the Seattle market, you have a lot of other markets. A lot of these are huge markets, right? So what you have to first understand is we need to divide the country in markets that are going to be ridiculous markets, obscenely hot markets, and then markets that have a little bit more of reasonableness. Now, for what Mr. Beg said, which is very true, the taxes in Chicago are high. It's not a tenant-friendly place. It's certainly the villages, if you're outside of city of Chicago, they're a pain in the ass, to say the least. I think I can say that online. And there are a lot of factors that you would think would not work for Chicago. Yet, if you think about logically, you're like, man, this makes no logical sense, Andrew. What are you talking about, right? And I'm glad people think that way. And a lot of people are like, well, people are leaving the state of Illinois. There is a net migration out of Illinois than net migration in. There is the highest amount of net migration in is in Florida, right? There's a reason why we're in a certain part of Florida. There's a method to this madness. And I'll explain that here in a minute. So 100% every single thing he said, he's right on. That has nothing to do with being the number one market. When I say the number one market, let me explain what I mean. What I mean by that is this, that you can find properties with the most amount of value in a market like Chicago. You can find properties, even in today's market, with the most amount of cash flow. in terms of the rental market. See, when Money Magazine or when Fortune or when Forbes or when any of these other magazines, when they rate the market, what do they rate it on? They rate it on highest amount of job growth. They rate it on highest amount of appreciation. They rate it on all the factors that make a market a very, very hot market, right? Lots of job growth, lots of companies moving in, lots of population influx. I don't base it on that. And the reason I don't base it on it is I base it on one thing. Does this market make you the most amount of money? Right? Because as a real estate investor, what I'm concerned with is not if there are a bunch of people moving in. What I'm concerned with is, hey, can I buy a property at 50 cents on the dollar? Can I buy a property at 40 cents on the dollar? And can I improve it and create massive amount of upside? If I can create a massive amount of upside, that makes for a good market from an investment perspective. We're guys in the investment business. Now, if you're the type of person that says, hey, I'm going to look at Austin, I'm going to look at Dallas, I'm going to look at Nashville because I'm looking for the highest appreciation, right? Then mind you, there are other markets. If you're looking for the overall, right, meaning the highest amount of equity on the time of buy, the appreciation, because normally the markets appreciate over a period of time. Not right now. Right now they're in a market where the prices are going to get corrected. Then you're looking at in terms of cash flow. So let's first understand what is a number one. Number one for me is not appreciation. Number one for me is not people moving in. Number one for me is not jobs. I'm looking at, is there an opportunity to buy the highest amount of cash flow? To buy a property, rehab a property, refinance the property out, even with today's interest rates, and make it cash flow, right? Does that happen for a normal long-term rental? Does it happen for a midterm rental, meaning 30 days or more? Does it happen for a Airbnb? For that, Chicago is number one. So let's look at the market in the country, right? So you got the New York market, which is obviously extremely, and by New York, I'm talking about New York City. I'm not talking about the state of New York. There are a lot of markets in the state of New York that are very good on cash flow. But a place like New York City is terrible on cash flow. Right? A place like LA is not going to be good necessarily in terms of cash flow generally. Now, they have changed some of the rules in that market, but historically it has not been good because today they allow your garage. You can put a second story on the garage today in LA, and because of the housing shortage over there, they will allow you to have a coach house. They'll allow you a lot of options. People can take their garage, convert it, and go ahead and rent it out. So the market, even in the LA market, as crazy as it sounds, and it's a very Democrat market, right? Generally, they're anti-everything, but they've had to let loose because why? There's such a housing crisis in that area. Now let's look at the Seattle market. Let's look at the Phoenix market. Let's look at the Las Vegas market. Let's look at the Florida markets. Let's look at the Texas markets. If we look at the some of the markets like Raleigh, as an example, or if you take a market like Nashville, right? These are all markets that are very, very hot markets. So what is a hot market? A hot market is somewhere where you have either Miami market is another example of that, where you have a Tampa, right? It's another example where you have a lot of influx of money and or people and or jobs. And sometimes they're all three coincide, right? So depending on what market, some of these markets, if you're looking at, these are the markets that most people pay the most type of attention to, right? Somebody says, oh my God, everybody's moving to Dallas and I want to go to Dallas. Well, great. It's a great market to be in. Why? Because the property prices are going straight up because everybody's moving there. There's nothing wrong with that. But you're not going to be able to get cash flow when I talk about rental markets. You're not going to be able to buy equity in those markets because why? Everybody's moving there and the market is too hot. That doesn't make it a bad market. It just makes it a market that's not number one, according to me, when it comes to rentals, because we're basing on cash flow, equity, and DCR. Those are the three things we base the market on. So if we look at the older cities, you take a Philly, you take Cleveland, you take something like, say, parts of Ohio. You take Chicago, obviously being the biggest one in that bunch of cities. These are what I would call the Rust Belt of America, right? These are older cities generally. They have some problems. A lot of times there are going to be political issues, right? They're not necessarily very entrepreneur-friendly cities, right? They're not necessarily known to tell you, oh my God, open businesses, go do lots of business. They're going to have a very messed up tax structure. They're going to have a lot of obstacles for people to be able to get in the business. Now, what does that do? What that does is when you have cities like that, where you have major populations, right? Guys, for the next 30, 40 years at least, right? I don't know about after that, but at least for the next 30, 40 years, that Chicago is going to be Chicago still. Everybody's been saying this for the last 10, 15 years. Oh my God, Indiana's growing, Indiana's growing. Indiana's right next door, right? I have the aircraft stored on the other side in Indiana because the taxes are much better over there. The fuel taxes are much better. Clearly, people see that. People move to Indiana. Some companies, big companies. In fact, Boeing, guess where their BBJs are stored? They're stored in Gary, Indiana. There's a reason behind that because the tax structure is different. But there's a reason why Chicago is Chicago still. And Gary is Gary. And if you look at the rest of the parts of Indiana, that are growing at a very rapid pace. But they're still not Chicago, right? There's a reason why Chicago's there. Still, it is the center of economy when it comes in the Midwest, right? And that's the case for the next few years. But when we look at it as a real estate investor, what we have to think about is why is it in a place like Chicago that there's so much opportunity? See, there's so much opportunity in Chicago because, number one, when was the largest increase in amount of rentals that are owned by investors and that are owned by hedge funds? That's been in the last 10 to 15 years. Before that, the hedge funds certainly were not in this business of owning 10, 15, 20,000, 50,000, 80,000 houses, a singular hedge fund in America. They were not in that business, right? Wall Street was not in that business. Homeowners or people, investors like us, there were a few people that owned properties, but owning multiple rental properties, 10, 15, 20, 30, 40, 50, 60, 100, 200 rental properties was not, quote unquote, a business, right? Generally, that you did not see that, or you didn't see as much. Today, what has happened is the amount of people that buy homes has gone down, meaning home ownership, but the amount of rental properties owned by investors or investment firms has gone up. And in Chicago, if you take as an example, when Blackstone came into Chicago, when a lot of the High Point, a lot of these big hedge funds came, they looked at Chicago as a mega center of about 9 million people. They came in, they had a huge operation, they shut down, and they went out. They still do loans in this market, but they don't do purchases in this market. Why not? Right? Why Dallas? Why a lot of other parts of the country, but why not Chicago? It wasn't necessarily because Chicago wasn't a good market. The reason they didn't do it is because of the reason that Mr. Big kind of pointed out. Taxes are high. Taxes in one town are not the same on the other side, on the other town right next door. There is no uniformity in Chicago. That's one of the biggest reasons, because every little town is going to have their own structure. So what it does is when an outside firm comes in from the outside and they're sitting in New York, or they have their tech center in Dallas, or they're sitting somewhere in Tampa and doing an analysis, they have to have a box, which is they call a buy box, meaning, hey, if the property fits this criteria, we're going to go ahead and buy because all the numbers fit. The problem with a place like Chicago is it's too unique. One neighborhood is not the same as the other. In fact, you can have one neighborhood where you can have extremely high crime, and then you move 4 blocks over, and you have an area which is one of the great areas to buy a rental property. I'm only sticking to rentals today because that's the discussion today, right? What makes Chicago number one is this, that what happened is when in 2008 is when the market started crashing. It crashed all the way, meaning by crashing, I mean property prices went down. And they kept going down all the way until 2012. But number of sales had picked up in 2010, meaning there were more and more properties that were being sold, but there were still properties that the property prices were still dropping, yet the numbers were going up. This is specifically in Chicago. So I'll give you a perfect example. If you take a suburb like Streamwood, or if you take a suburb like Hanover Park, you take a suburb like, say, Midlothian, for example, down in the southern suburbs, you take a suburb like Waukegan up north, right? So I'm comparing a suburb which is west of town, I'm comparing a suburb south of town, and I'm comparing a suburb north of town of Chicago. If you study this, and this is something, the reason I did well is because I did more homework than most people will ever do. The reason I did more homework than everybody else was I was scared. I didn't do more homework because I was that smart. I did more homework because I did not want to lose like other people were losing in that market. So here was the homework. So I'll give you an example. A 3-bedroom, 1-bath ranch, 930 square foot ranch in the city of Streamwood that was in terrible condition, right? Terrible as in like there's stuff all over the place, painted green on the outside, right? I was selling. As a real estate agent at that time, I was selling for $215. And yet that same ranch, after 3 years as a foreclosure, I was buying that same exact ranch, me selling as an agent, and me buying that same exact ranch for $70,000 and $75,000. This is, mind you, in 2010, 2011. In 2008, that same ranch would have sold for about $180. 2009, that same ranch would have sold for $130. 2010, that same ranch would have sold for less and less and less, right? What happened was, as each year progressed, the foreclosure inventory was selling at a very deep discount. And that discount was an artificially deep discount. Now think about why that is the case. Generally, you would think a property is worth $200,000, all fixed up in good condition. Now, you would pay about 70% of that as a general rule. 70% of that is what would be a general rule for a flip. So 140 minus the rehab cost, which is, say, 30, 35,000, which was at that time for 30, 35,000 bucks, you could really redo the house completely if you knew what you were doing. So meaning you should be paying 100 grand for that house. Yet, if I'm able to pick up that house for 70, what has happened is this. Last time in the history of the Chicago market, when was that ranch worth 70,000 bucks? If you don't know, I'll tell you when it was. In 62 and 63, when farmland was demolished, right, or farmland was taken over and those ranches were put in. What had happened was, in a time in history, and this is something people don't realize, why Chicago market created such artificially high spreads. Because what happened was, investors like me at that time, how many houses could I buy at that time? Right? I used to do 3, 4, 5, 6. At one time, I was up to 17 or 18 houses at a time. But once I buy a house, I'm stuck in that house for about 6 months. I didn't have the inventory. Even at a time when I was doing a lot of rehabs were, for me, were 10 to 20 rehabs at a time. Right? That's a lot for a one-person investor to do at a time. And then you have another 5 or 8 on the front end coming in under contract. You have another 5 or 8 either pending contract or they're on the market for sale. And you have all this inventory. But your average person was maybe doing 1 or 2 a year. That's your average real estate investor. So why there was such a gap, and why in Chicago such a big wide margin opened up compared to the rest of the country? The reason for that, the reason was this, that in 2011 and 12, that when all these big hedge funds started coming into the market and started pouring funds into the market, initially they had these big plans because they're like, well, if it works in Dallas, if it works in Austin, if it works in Tampa, if it works in Florida, it's got to work in Chicago, right? I mean, it's simple. But the problem, what they did not realize, which is where the market kind of messed with them, was that, hey, guess what? Evergreen Park is not the same as Posen next door. Posen is not the same as Beverly next door. If you go to Chatham, one block of Chatham is super nice. And then you have 2 blocks that may be interesting to say the least. Now, that doesn't make an area good or bad. It is what it is. But for a big hedge fund that says, hey, we're going to commit $100 million in XYZ market, buy up the inventory. They're sucking up inventory like a large vacuum. And what's happening is a lot of bad properties, meaning a lot of properties that may look good from the outside, But when you really start delving into it, when you start looking at all the headaches the villages gives you, all the other problems that go along with buying a property, all the nuances, because the devil is in the details. So what happened? A lot of hedge funds realized, oh my God, if we're going to buy in that much volume, we cannot be in a market like Chicago. So then what did they do? They exited this market and they doubled down in a market like Dallas. They doubled down in a market like, say, Nashville or Tampa or hundreds of other markets that these people were in. Why? Because those markets were based on pure appreciation. That they would buy the property, they hold the property over time, the properties would appreciate, they would package all of them together, they would stamp a AAA rating on it, boom, put it back and sell it to a MetLife, sell it to a teacher's fund, and they made millions. See, while we were thinking, people like us, right, that are normal everyday people, we're thinking that they're in the equity business, they're in the cash flow business. They were never in that business. They were in the business of basically buying up huge number of properties, putting them back as quickly as possible, putting tenants in them, packaging them all together, putting a rating on it, a bond rating on it, and selling that over to a teacher's fund that's looking for a 3 or 4% yield. And guess where they could do that? They could not do that in the Chicago market because the market is too nuanced. The reason Chicago is number one market is because the hill is very steep for most people to climb. And for most people that are from the outside, meaning from an outside market coming into Chicago, it is very hard to figure out. So what that does is that creates an opportunity for someone like you, if you happen to be in the market or understand the market, especially the nuances of it, right? And if you are a local investor, this is a joke I've had with Ryan Smith, the number one REO agent in Illinois, King of Southside, Mr. Frank Montrose. We've had this running joke all the time, right? And it's funny when it's not your money, right? It is real funny when it's not your money on the line or not your butt on the line, but it's very painful when it's your money or your butt. I mean, Frank's given example after example at the 3-day that how people would come in, oh man, I got $4 million to invest. I'm an investor from California, right? And I do XYZ in LA. Well, guess what? What you do in LA has nothing to do with Chicago because there's nothing normal about the Chicago market. I mean, you got downtown, then you got South Side, then you got southern suburbs. Southern suburbs have nothing to do with how things are done in South Side. And it's not right or wrong. Sometimes people are like, well, you're saying good or bad. I'm not saying good or bad about it. I'm just saying the market is how it is, right? If you go to the South Side and you don't know what you're doing, this is the important thing. If you don't know what you're doing, I mean, you're going to get killed. I'm not talking about figuratively. I'm not talking about literally. I'm talking about financially. Why? Because each block is very, very different. So there you need to work with somebody. I mean, the King of Southside, Frank Montrose, I'm the one who said, hey, you're King of Southside. Why? Because he does so much damn business there. And if you don't work with somebody like that, then you're going to hurt yourself. See, the reason why the margins in Chicago are so artificially high, because it's a very difficult market to penetrate, right? And to understand. But if you're somebody who's local, if you're somebody that is local in the Chicago market, you have an inordinate advantage over anybody else that's from the outside. But the problem is this: if you live, let's just say, in the outer suburbs of Chicago, and you're going to say, I'm going to go from outer suburbs of Chicago and go invest in the city of Chicago, and you don't know how the game is played over there, guess what? You're going to, not if you're going to make a mistake, you're going to make a mistake 110%. Why? Because it might as well be investing in Mexico, right? Because how the business is conducted in that pocket of town, what the nuances that you look for in certain pockets of Southside are not going to be the same as you would if you're rehabbing a property in Streamwood. And this is what people don't understand, that the level of fit and finish that you have to do at different parts of town, the amount of money that you're going to pay, those are very different. And because there is so much disparity, what it did was it provided for 2-3 reasons. Number one, because none of these villages were easy to work with. So what it did is it slowed down the level at which we could clean out the inventory, right? there was not a lot of foreign investment that was coming into Chicago compared to, say, Miami of the world, or Las Vegas of the world, or a lot of the other parts of the world, right? Where you had all this foreign investment coming in. So it drove the prices up really quick. So in relation with the amount of rent you could collect versus in that moment in time, how much you could buy the property for. And then based on that, the yield curve that would create, that yield curve is what is highest in Chicago. Whenever I say Chicago is the number one market, the technical way of saying it was Chicago is the number one market for rentals because it gives you the highest yield curve, meaning to find properties at 50% of market value, right? 40% of market value, to be able to add 30, 40, 50,000 into it and increase that delta at a very high rate, and then charge a substantially chunk of change in relation to how much all-in cost is in the Chicago, in that particular deal. That factor in Chicago, that yield curve, is what we're all investing for. That yield curve is number one in Chicago. So even though taxes are high, right? Even though the city is not very friendly, neither are the suburbs very friendly. That makes it difficult. What does that do? That keeps a lot of the hedge funds out. That keeps big investors from around the country out. Hence, it gives you and I an inordinate opportunity to be able to find some of the best deals. And mind you, obviously, you're talking about a population of 9 million people or so, right? Why is it that in Mastery, a group of about 1,100 people, 1,200 people own 18,000 plus rental properties? The reason behind that is this, because it is a kind of an artificial market where you can operate because it is a more difficult market to operate in. So if you understand how to work in that difficulty, it yields you a very high rate of return. It's no different than if you compare an A suburb in Chicago, right? An A suburb in the Chicago market generally will yield you a low yield in terms of rental, meaning all in price, purchase plus rehab, any carrying cost, versus the back end. Versus if you go to some of the areas which may have higher crime, generally you can buy a property and yield a much higher yield curve there. See, I don't want this because getting shot, getting mugged, and getting robbed, it's not in my business plan. So I'm not going to necessarily go to an area that's very challenging in terms of crime. I can't go to a high area. Like every property I own, I would love to own every single house in Schaumburg or every single house in Northbrook. That would be great if I can get as high a yield curve. But because I couldn't, I had to go to Streamwood. I had to go to Hanover Park. Then I had to go to Elgin. Then I had to go to Lake in the Hills. Then I had to go to Algonquin. Then I had to go to Dundee. Then I had to come down to the southern suburbs. Then we started buying Hillside, right? The reason is because A areas will not give you as big a yield curve. The reason we are number one in terms of a return is because it is a hard market to penetrate. And because it's hard, that's why it gives you an unfair advantage. Hopefully, I know this is a complex topic, and this is not the easiest thing to explain to most people, but hopefully I have at least done a decent enough job that it makes sense why I say what I say, because I challenge you. And this is not a challenge meaning that, oh my God, I'm bragging about it. I challenge you because I would love for you to show me the returns that are possible in this market, meaning in the Chicago market. Guys, I can promise you, you can't do them in Florida. You can't do them in Dallas. You can't do them in Houston. You can't do them in Phoenix. The cash-on-cash returns I'm talking about, right? The yield curve that you can get out of Chicago. We have looked at a lot of markets. The only reason we started building in the Florida market is because I wanted to diversify from Chicago, and we're like, okay, in that market, we'll do new builds and we'll do either Airbnbs with those or rent them out. But there, it's not like I can buy an existing house and create the same yield curve that I can create here. So there, we're having to build duplexes, we're having to build triplexes from the ground up. So that's just something that we're putting in way more effort over there to build an inventory, but that's a different business plan. So I hope, so Mr. Beg, thank you very much for bringing this up, because this is a topic that's very near and dear to my heart. If you don't understand, especially if you're a Chicago investor, guys, now interest rates are up. 100% they're up. I just closed 2 loans today, right? Even with a buy down, on one of them, I paid $8,000 in buy down. Another one of them, I paid $9,200 in buy down, buying the interest rate down. I still ended up paying with great credit, with great everything, all my ducks in a row. I still paid 6.75. For a normal person, that, I mean, now since then interest rates went up, you're at 7.5. Here's the cool part though. Guess what's happening to prices? I just today made an offer on a property that's listed for $282,000. 164,000 bucks, and guess what? Boom, it's accepted. Why? Because the sellers are desperate. Now is the time that you and I need to double down. There's only 2 things happen when the market corrects. The people who have no idea what they're doing are going to get out. It's our job, it's your job and my job to double down, and guess what? Go hard, right? Take a vacation when everybody else is getting in, but go hard when everybody else is getting out, because that's when you really build a bloody fortune. Having said that, this is Andrew Holmes. If you haven't joined, join Burr Cashflow Investors on Facebook. 3-day is coming up, guys. You click on the link, National RE Invest. If you haven't joined, make sure you join. Meet us at the 3-day. This is going to be an amazing event, and look forward to seeing you as we go into the next year. Talk to you soon.